Hi, this is Seth David from the world famous Nerd Enterprises Incorporated, bringing to you another special screencast. This time we're continuing with our series, QuickBooks Tips on Tax Planning, the Analytical Review. Knowledge is power. Make an impact by learning more. Call me right now at 866-945-8070 for information about private trainings. I send you a link. You can log in with us. Share your screen with us. We can coach you through learning whatever you need to learn. And then we give you a video of the session at the end of it so you can review it as often as you like afterwards. Okay, we're ready for segment 2, actually segment 3 of our series here on QuickBooks Tips on tax planning for your 2011 taxes. This time we're going to be looking at analytical review, and that means just that. We're going to analyze. So we're going to run a report. This time we'll start with the profit and loss, because we did the balance sheet review pretty thoroughly. We're going to come back to that. We want to set it for, normally we'd set it for last fiscal year, but since I'm in a sample company file, I'm going to set it for this fiscal year. And then I'm going to come in here to customize the report. And what I want is I want the previous year, and I want the percent change. You can do the dollar change, but I don't think that really gives us as meaningful information as the percent change does. Because the percent change sort of gives me context. It shows me how much I increased, you know, this year over last, or how much I decreased this year under last. So I like the percentage change. If you like the dollar change, you can play around with that. Maybe you like it better, but of course you'd be wrong. No, I'm just kidding. So looking at this, and again, keep in mind this is a sample company file, but let's just say it wasn't. The first thing I might guess is that we are in a second year of operation, right? Because the first column is the last year. The second column is the prior year that we're comparing to. And then it gives me the percent change. And obviously sales went up way, way up 1 year over the next. And this is typically indicative of a company that had just started and now has ramped up sufficiently and is running, you know, a kind of normal status, level, whatever you want to call it. It could also be that we just did a whole lot better this year over last year. The point is you want to look at something like this, and immediately my attention is drawn to it because I see a huge difference, 4,000% increase. You know, it kind of raises the question, how? How did I do it? Because I want, whatever I did to do that, I want to do more of that, right? Because I want to keep increasing. If I can do a 4,000% increase in sales every year, I'm going to be doing really well, really quickly. So, you know, but if it's just because last year was our first year of operation, we just started at the end of the year and we're just ramping up, then that's important to understand because it gives this context. And that's the whole point, is looking at this year compared with last year, or last year compared with the year before, and seeing if the numbers make sense. 4,000% increase in sales should indicate an expected comparable increase in cost of goods sold, and that sure enough is what we see here. So now you're just, again, just like in the previous review, you're thinking in terms of what would I predict, what would I expect to see, and then asking, do the numbers support that? Do the numbers support what I would expect to see? Why didn't I have any installation labor last year? Again, maybe because we were just starting. We hadn't actually started working on any jobs yet. You know? I don't know. Going through, but this is what you want to do. You want to do this analytical review. You want to compare, you know, the previous year with last year, or this year with last year. And you want to look at the percent changes. You're looking essentially for the significant variances, for accounts that changed by a lot. And when you see that, when you see an account that changed significantly, then you want to ask yourself if you can explain why. Or it may be that, as in a case like this, as soon as we understand what happened here with sales, then the expectation would be that everything this year should be dramatically more than it was last year. If you're a business that's been in business for a while, then this probably has a lot more relevance because you have a much better context in terms of being able to, you know, knowing that you're comparing 2 years that are actually comparable. You know, if we're really comparing 1 year to a year that was a startup year, then it really may not be comparable, other than just to, again, you know, make sure that we can see what we would expect to see. So that's one thing we do. The other thing we do is we can get rid of this now, go back to the standard P&L, but then over here in the total only, you want to total it by month. And when you total it by, I can't tell you how many times I do this for clients when I'm logged in remotely with them, and they're like, oh my God, I can't believe you could do that. I didn't know you could do that. My CPA never told me I could do that. And I usually tell them that's because a lot of CPAs don't do this. They just run the P&L and balance sheet and use the information to populate their tax software. So Don't expect that your CPA knows how to do everything there is to do in QuickBooks, because a lot of them may just be using it for what they need, which is to get a tax return filed. You have different needs with respect to your QuickBooks file, like this, like analyzing the numbers and making sure that you can explain them, making sure that they make sense, and then trying to decide what they tell you about the business. So a lot of times with this one, I go right to the bottom, and I look for the months where we did poorly compared with other months. So if I see a month like this, where most months look profitable at least, and all of a sudden we show a big loss, then the first thing I do is say, all right, was it in the expenses or is it in the income, right? Expenses look about the same, actually look a little bit lower than the 2 months around it. Let's jump up to the top. Sales went way down. So what I might want to do is ask myself, why did sales go so far down? Right now, this is a manufacturing company that does what? What do they do? Let's look at the item. Let's see if we can tell what they do. I think it's pool installation and parts, something like that. Something like that. Maybe. So anyway, you could. The point I was getting at is, if you understand what business these guys are in, then you could get a little bit of context in terms of maybe I would expect to see sales go down, as we're going into the winter here. But still, you want to look at that, and you want to look at the trend and see if you can explain it. Like, man, we had a great month in September, dropped way down from there to October. We want to explain that. For that matter, we want to say, what do we do so good in September? Can we do more of that? Right? I might want to run a sales by item report for the month of September now. Right? Sales by item, not sales by customer. Let's do a summary and we'll date it for September, right? Oops. I can't type. 9/30/16. See what we sold. What did we do so well? Now this is just the, I guess, inventory items. It is pool covers and stuff. Let's see if that makes sense. There's the equipment sales is 53,000. So let's see what's in here. Okay, looks like we did 2 big sales. Okay, so when I double click, when I drill in, I get some real good insight. All right. Well, then we want to see, how can we do more of this? How do we get this customer? And how do we get more customers like them? This is the kind of information. So like I talked about in my recent post on analyzing your sales to maximize your ROI, and specifically I was really referring to the return on the investment that you make into your bookkeeping. We can use this information to maximize that return on investment, because we can use the information to give us some insight into what we should be doing. Because we can look at, which clients gave us the greatest sales, how do we get them, how do we find more clients like them, and you can start thinking along these lines. Otherwise, I'm just blindly going in and saying, well, I think this product does well, let's market that. Let's do a video about this product. And as I pointed out there, I might be then doing videos and marketing on products that are already selling well, when there are other sort of unsung heroes within my product list that I could be focusing on to bring sales up in those items. And they might be more profitable when they are selling more, because they might have a higher margin in them. So it's that kind of information that you really need to analyze, that you'd never know just from running a P&L and a balance sheet. It's so important to spend time doing this stuff. Even if you just do it for an hour a month, it's so worth it. So important to do. So that, my friends, is pretty much your comparative reports and your monthly reports that you want to run and play around with. And you can do the same on the balance sheet. The balance sheet is, you have to keep in mind what you're looking at here. Remember, the balance sheet balances are cumulative. So if I do this for this fiscal year, and I told this by month, remember, these balances don't add on to each other. They flow into one another, right? So these are cumulative balances. So it's important to understand what you're looking at when you look at it. But you can analyze here. You can analyze kind of cash flow wise, looking at your bank accounts. It looks like you had a net overdraft in the month of August. September, we saw that sales were really good. So in October, sure enough, I'd expect my balance to increase, because theoretically, it might take a month to collect, right? So again, you have to think about the timing of these things, and the whole idea is, once again, to try and predict what you would expect to see, and see if the numbers sort of vouch for that. And if they don't, then you want to look into it and investigate and find out why or why not. Right? So you want to really start looking at this stuff with that kind of analytical eye, and ask yourself, does this make sense? And then ask yourself, what does this tell me about my company? How are we performing? Are we carrying too much inventory on the books? Do we need this much in inventory? Or are we running the risk that things get obsolete because there's stuff in here that we're buying more of and we're not really even selling out of it? So again, lots of information to be looked at here when you're doing this kind of analytical review. Please post your comments below. Let me know what you think, what helped you, what didn't help you, what you already knew. Let me know if you already knew everything. I'd like to get to know you better. And I hope you're having an absolutely fantastic day. And I do look forward to seeing you on the web.